Hi, this is Mr. Gideon. So we've talked much more in depth about trade at this point, the benefits of trade, and also the reasons why governments would restrict trade. But we can't neglect the other side of the equation. As you've known for a long time, going back to the beginning of the semester, there's no such thing as free. And so, in exchange for goods, services, and the factors of production, people expect money, of course. So that brings us to international finance. Now, despite the fact that many countries restrict trade on some level, we consider most to be open economies. An open economy is an economy in which there are economic activities between the domestic community, citizens of a particular country, and people outside of that country. And you can visualize an open economy by going back in your mind, or even in your notes, to this portion of the circular flow. This is the exterior of the circular flow, which we call the international sector, and if you'll recall, on one side we have the goods and services market, also known as the products market. On the other side we have the factors market, also known as the resources market. And people in an economy are buying and selling factors of production as well as goods and services. But of course, there's an equal and opposite reaction, so to speak, and that's the money that's being exchanged, both for imports and exports. The opposite of this, of course, would be a closed economy, and if you were going to visualize that with a circular flow, then you would just have the C, the I, and the G, and no NX. But once again, go to the following link that we have here, we've used it before, to see recent import and export numbers for the United States. Click on Exhibits 3 and 4 to see exports and imports of services. It's easy to forget that we buy and sell services, but also click again on the Exhibits 7 and 8 to see exports and imports of goods and products. When you go there, particularly with Exhibits 7 and 8, you'll see that there's a caption that says Total Balance of Payments Basis. This is the balance of payments, the accounting process that countries use to track these kinds of transactions. In 2008, people living in the United States sold about $3.5 trillion worth of stuff to people living in other countries and bought about $3.5 trillion worth of stuff in return. So, as I said, the way that we keep track of these transactions is through the balance of payments accounts. The balance of payments accounts are records that companies keep of their international exchange, both real and monetary, by calculating their balance of payments. The balance of payments tracks exactly that, the money that's flowing back and forth between countries. It's a periodic statement of the money value of all the transactions between residents and the government of one country and residents as well as governments of all the other countries that they do business with. Balance of payments accounts record both debits and credits. Any transaction that involves an outlay of domestic currency in exchange for foreign currency so they can do business is recorded as a debit. Any transaction that involves the receipt of foreign currency in exchange for domestic currency is recorded as a credit. It's important to know the difference between a debit and a credit. Here's a visual that can perhaps help you with that. On the top line you'll see for a debit we have any transaction that supplies a country's currency, and an example could be Jim, an American who supplies dollars in exchange for yen so that he can use the yen to buy Japanese goods. Typically, when you're going to buy a good, a service, a factor of production from somebody in another country, they're going to expect you to pay them in their currency. Think about the reverse. Let's say that you were a student at Chaminade selling, let's say model toy trains. I've had a student do that recently, and he sells it to people all over the world. He collects them, keeps an inventory of several $1,000s. When he finds a good buyer for one of these model toy trains, many times antique, then he conducts a transaction over the internet, and he expects to get paid in dollars. He can't use yen at his local pharmacy or to take somebody on a date or anything like that. He needs US dollars. That's the currency that we use. That's generally accepted as a form of payment, of course. So something like that would be a debit. A credit is a transaction, of course, that does the opposite. It creates demand for the country's currency. So, for instance, Svetlana, some Russian who's living in Russia, supplies rubles, which is their national currency, in order to demand dollars so that she can use dollars to buy U.S. goods, like a model toy train. Another way that you might want to think about this is the difference between debit and credit cards. If you're going to go someplace and make a purchase with a debit card, it's a little different kind of transaction than making a purchase with a credit card. If you use a debit card, what you're doing is drawing on money that you should already have in your bank account, and you can think of that as taking money out of your account. A negative is a debit. If you use a credit card, somebody is crediting you with the ability to make that purchase, and so it's a positive to your financial situation. Somebody who gave you that card, let's say Bank of America, who sold you this credit card, credits you. So perhaps that'll help. Another way to think of this that might be useful is that money going out is a debit and money coming in is a credit. And remember that they call this the balance of payments because that's what it tracks. It tracks payments. Show me the money. That'll help you figure out the difference between a debit and a credit. So the various debit and credit items that make up the balance of payments are grouped into three accounts. The current account, which is the first one, the financial account, which up until a couple of years ago used to be called more commonly the capital account, but know both of those terms. It's the financial or capital account, and then the official reserve account. Let's look at a hypothetical balance of payments. As you can see here, in the beginning we have the current account, which is really the main focal point for most people that try to analyze trade between countries, because most of the time they're looking at exports and imports of goods, as well as services, but primarily goods. And you may have even heard of the merchandise trade balance, or just trade balance, that one or more countries might have with each other. You might also know that the United States has a negative trade balance, and when you hear that term in the news, this is what they're referring to. In this hypothetical example, it's the difference between item 1A, right here, a positive 220, in terms of money that we would get in this hypothetical example for selling, exporting merchandise to people in other countries, minus 300, that is the debit as a result of importing. In the case of the United States, you probably know that we import a heck of a lot more than we export. As a matter of fact, the busiest port in all of the United States is not too far from where you live. LA Long Beach Harbor is the busiest port, and recent figures show that we import through that port 10 times more than we export. So there's a significant trade imbalance. So that's the current account. Then there's the capital account, also the official reserve account, and then there's space on a balance of payments for statistical discrepancy, so that at the end of any one country's balance of payments, we end up with zero. And if you stop and think about that, hopefully that makes sense, why that would be the case. The sources of money must equal the uses of money, because every dollar has a source, and every dollar received gets used somewhere. And that goes for countries, not just individuals. Even if somebody puts their cash in their bedroom closet, that is a use of cash. So the total should always equal zero. Now let's get a little more in depth with these different accounts for the balance of payments. The difference between the current account and the capital account, they're the ones that get talked about the most. And remember, the capital account is also known as the financial account, is how these two groups of transactions affect the future. Transactions in the current account, like the sale of wheat to a foreigner, conclude now. Everything happens now. The impact is current. That's why my shorthand is that I call it the now account. Transactions in the financial or capital account, like the sale of a bond where the seller agrees to pay back the loan in the future, conclude in the future. And that's why sometimes the shorthand I use to refer to the financial account is the future account. So think of current as maybe current events, that kind of an association, something that's happening now and finishing now. And then the financial account and future account, there's alliteration there. Think of the two F's kind of connecting together. If you're talking about the financial account, the future account, those are transactions that create a liability. Remember, a liability is where you owe somebody some money that is expected to be paid in the future. That's different than a current account transaction. So, that being said, let's take a look more at the current account, or as I call it, the now account. The current account includes all payments related to the purchase and sale of goods and services, as well as unilateral transfers. Unilateral means one way. It's not like a purchase where you say, I want that iPhone, here's my money in exchange for the iPhone. That's a two-way transaction. Unilateral just means one party acting in one direction, not expecting anything in return. So the current account includes unilateral transfers of funds from one country to another. The current account has three major components: exports of goods and services, imports of goods and services, and then the net unilateral transfers abroad. So what are these things? Some of them might seem more easily palatable to you than others because you've heard of these before. First, exports of goods and services, as well as income from U.S. assets abroad. Americans bring money into the country. Remember, this is a credit to the balance of payments. It's a plus by exporting goods, merchandise. Also by exporting services and receiving interest income on foreign investments, mostly payment on loans to foreigners. So all of these kinds of transactions would be a source of a credit, a plus to the balance of payments. The current account also has imports of goods and services and, as you might have guessed, income from foreign assets in the United States. So just like Americans bring money into the country as a credit, Americans send money out of the country, which is a debit, a negative, by importing goods, by importing services, and by paying interest income to foreigners that have investments here. Now, speaking of the merchandise trade balance, also referred to as a trade balance, which is the difference between a country's exports and imports of goods alone. This is only goods, not services, not transfers. The number can be positive, negative, or zero. And here are some actual figures from recent years for the United States. As you can see, a very significant and negative trade balance. Some people would say this is a trade imbalance. Now, whether this is good or not good depends on who you are and what your perspective is. Sometimes the knee-jerk reaction is, wow, that's bad news, but not necessarily to everybody. International transfers, the net unilateral transfers abroad, are, as I said before, one-way money payment from citizens or the government of one country to citizens or government of some other country. So let's say our government decides to send aid to some African countries, other countries besides those in the continent of Africa. That would be accounted for under international transfers or net unilateral transfers abroad. The main element here, though, is for, like in the case of the United States, remittances that immigrants send to their family members in their country of origin. In California, a common practice for Mexican-born workers, for instance, is to make money here and send it back, at least a good chunk of it back to their family in Mexico. So that's a big chunk of the number for the United States when it comes to international transfers. So that's it for the current account. Now, the future account. The financial account, also known as the capital account sometimes, includes all the payments related to the purchase and sale of assets, as opposed to buying goods and services. Visualize some people buying factors of production, land, labor. More importantly, though, financial capital, which is, of course, what you need to run a business. Now, if there's outflow of capital from a country, let's say the United States, in other words, people are purchasing assets, this is where Americans would be, once again, sending money out of the country. That's a debit. This can include official transactions involving foreign governments and Americans in the form of Americans buying foreign currency or foreign bonds, as well as private purchases of foreign assets, like an American buying land in Japan. Land is one of the factors of production, right? And it's an asset. The opposite transaction is an inflow of foreign capital or the sale of assets. So, if you're looking from the U.S. perspective, Americans bringing money into the country, which is a credit, by selling assets. This can include official transactions involving the U.S. government and foreigners in the form of selling U.S. currency or U.S. bonds, as well as private sales by people like you and me, let's say, or even companies and corporations, like when the Belgian corporation InBev bought American corporation Budweiser in 2008. And in theory, even though most of the time it doesn't always come out this way, the current account plus the financial account should equal zero. Now, two more accounts that I referred to earlier. The official reserve account. This is the account that the government uses to possess official reserve balances in the form of foreign currencies, gold, its reserve holdings in the International Monetary Fund, the IMF, and special drawing rights. Countries with a deficit in their combined current and capital accounts may draw down these official reserves, resulting in a credit to the official reserve account. Countries with a surplus in the combined current and capital accounts will accumulate additional official reserves, resulting in a debit to the official reserve account. And make a note in the back of your mind about this account. It doesn't get talked about a whole lot when you're thinking about trade and you're answering questions in this class or the AP exam when it comes to trade. Most of those questions are focused on the current and the financial accounts, but this is an important account for when we get back to talking about exchange rates and the policy goals that governments have as to whether or not they want to implement a fixed exchange rate regime or a flexible exchange rate regime. So make a note here. And then you have this last category for statistical discrepancy. As you can imagine, all of the money flowing in and out from any one particular country is impossible to track down to the penny if you want to stick with the U.S. currency orientation. So in addition to the current capital and official reserve accounts, the balance of payments includes this category for unreported transactions. We can only track what we observe. We can miss smuggling activities, secret bank accounts, people living in more than one country, all kinds of different things. But usually they're pretty good at estimating everything that is not included in statistical discrepancy. So once again, going back to our hypothetical example, we have the current account, which includes exports of goods and services. So some country exports, and they get money in return for those exports, whether it's goods, merchandise, services, and income from assets abroad. So all of those would be pluses, also known as credits. On the flip side, a country could have imports, which would result in a debit or a negative. We look just at goods, just at merchandise. That's the focus for the term trade balance or merchandise trade balance. Don't forget, we also have net unilateral transfers abroad. This is governments sending each other money to help out or maybe to try to help with their international interests, but of course citizens or residents sending money to people in other countries. A lot of times it's family members that they have in their country of origin. But all these things happen relatively immediate, and so think of the current account as happening now. Then you have the capital account, the financial account. Think of it as the future account, where there may be some transactions, there are actually transactions in the current year that can be recorded here, but there's an ongoing liability. The final word will be settled in the future. So that's the second account, and then we have the official reserve account, which countries have, particularly to enact whatever goals they have with regards to currency and exchange rates, and we're going to talk about that shortly. Then you have statistical discrepancy, but at the end of any balance of payments, you should always have zero.